Hello, good morning. My name is Jamal Khan. I'm the head of tax at Churchill Tax Advisors, and we are doing our weekly tax update. Following from our previous or last week's update, when I spoke about property tax and tax planning for landlords, I spoke briefly about the transferring properties into a limited company, which is becoming which is a hot topic at the moment for landlords who have a number of properties with mortgages, and the Section 24 rules, which restrict tax relief on mortgage interest. So a lot of landlords are resorting now to transferring properties into a limited company. Now, first, as I mentioned last week, there are a couple of steps to follow. When you transfer a property into a limited company is a separate legal entity. So it's liable to capital gains tax and stamp duty. The way we get around capital gains tax is to check if there's a trade, if the landlords are effectively managing the portfolio, say more than 20 hours a week, and that somewhat gives you relief from capital gains tax. The next hurdle is stamp duty, which is more difficult, and there are a lot of anti-avoidance provisions around stamp duty. So you've got to be very, very careful. Some ways around stamp duty are to set up a partnership, run that for a couple of years, and then to transfer the assets from the partnership into a limited company. But there are anti-avoidance rules that can apply. But now we've come to this stage, which we covered last week. Now and during the last couple of days or last week, I've had a large number of inquiries from people asking about more information on people transferring properties into a limited company, advantages and disadvantages. I'll cover the advantages first, which are, yes, when you transfer into a limited company, the first advantage is that transfer properties into a limited company. The first advantage is that the companies can get full tax relief for mortgage interest payments. This is as of yet. So the rules for Section 24 only apply to individuals and not to limited companies. But we don't know that whether this will apply to limited companies. These rules will be extended to limited companies in the future. So you've got to be careful, because what happens is, yes, you make a decision to put a property into a limited company. So you might have 10 properties and you transfer them into a limited company. Now, you might get tax relief for a while, but if the rules change, you might be stuck. Because you cannot get properties out of a limited company so easily. You have to pay a lot of tax, capital gains tax, corporation tax, income tax, and stamp duty, etc. on the way out. So there are no exemptions as such for getting properties out of, especially if the properties are worth a lot of money, more than £100,000, then you cannot get properties out of a limited company. One advantage is, yes, the properties get revalued or rebased for capital gains tax purposes on the way they go in when they go into a limited company. So, for example, if you bought a property for £50,000, now it's worth £500,000. When you put them into a limited company, they get rebased for £500,000. So when you come to sell the properties in the limited company, your base cost will be £500,000. So if you transfer the property into a limited company, this is what a lot of landlords are coming to me for advice. You transfer it into a limited company at £500,000, and you do claim exemption from capital gains tax relief from capital gains tax. And when you sell it, say for example immediately after incorporation, then there's no capital gains tax to pay, which means you've just saved yourself a significant amount of capital gains tax. So this is one of the advantages, tax planning advantages for putting properties into a limited company. However, there are bigger issues to cover. For example, as I mentioned, the properties are stuck in a limited company, you cannot get them out. For example, if somebody has, say, 4 children or 3 children and they want to give properties to their children, they will struggle because the properties are stuck in a limited company now. They cannot give properties, they cannot distribute the properties to their children. So that's something to watch out for. Second problem is that double taxation. So if you sell, say property receives, or if you sell one of the properties, property makes a capital gain, the company pays corporation tax or capital gains tax, and then you want to get the money out to yourself, so you've got to pay tax on dividends, which is quite high now since the last couple of years. So you can end up paying double taxation getting money out of a limited company. The third one that we watch out for is inheritance tax. With limited companies operating as investment, holding residential properties or investment properties, these are not trading companies. So the inheritance tax problem gets even bigger with transferring properties into a limited company. There are some people, some advisors who say that, yeah, no, it's treated as a trading company, but it can never be. A company holding investment properties will always be an investment company. It will not be a trading company. So that's something to watch out for. Say, for example, if the property, somebody's transferred their properties into a limited company, if the properties are worth, say, £5 million, in 10 years' time, the properties might be worth £10 million or £15 million. In that case, that person's estate has gone up, and there will be significantly more inheritance tax on their death. I will cover inheritance tax in my next few webinars or my updates. But there is a lot to consider. There's a lot to consider in property tax planning and how to effectively manage your estate and income tax and capital gains tax. And if you've got any specific questions, you can call me, you can ask me, or you can email me. Now, coming back to the weekly case update, this is the case of Cliff versus HMRC. This was announced a week or something ago. Mr. Cliff was a self-employed tax consultant, and he had offering his services to racehorse trainers, jockeys, breeders, etc. And in his tax returns, together with his income from tax advisory services, he was claiming loss relief for, he called himself a dealer in thoroughbreds, so thoroughbred horses, and he made losses. He claimed a lot of losses. HMRC started a tax investigation, and they found that his claim for these losses was he didn't actually have a trade in thoroughbreds, and this was just a made up. He went and appealed against the assessments and the discovery assessments and the penalties, but he lost because obviously the trade doesn't exist. So HMRC can check when people claim loss reliefs against their income, and I've seen quite a few cases because we deal with tax investigations. Quite a lot of large part of our business is tax investigations. We've seen a lot of people who've tried to falsely claim losses to mitigate their taxes. HMRC have caught up with them ultimately. The next one is Leeds Cricket Football Athletic Company Limited. This one is the company sold a cricket ground, but there were a lot of stalls around it, and that they were sold with the main cricket ground, which comprised a trade effectively. HMRC challenged that the trade did not exist, but the matter went to court, and the judges decided that the cricket stadium was not a standalone, and then ancillary services such as catering and other businesses and advertising, etc., were regarded altogether as one big trade, and therefore when the owners tried to claim holdover or rollover relief, that was allowed. The main argument on this was that the owners tried to claim rollover relief and HMRC denied it, but then it went to the court and this was allowed. If you like our videos, please please raise thumbs on YouTube and subscribe to our channel. Otherwise, I'll see you next week. Thank you.